journey and your last two. I swim with tea when they turned in. The staring out to mute. And can land a pole that sunky died.
When preparing a T2 return, one important rule to remember is that a corporation cannot always claim the full amount of its charitable donations in the year they are made. The Income Tax Act generally limits the charitable donation deduction to 75% of the corporation's net income for tax purposes for the current year. Let's look at a simple example. Suppose a corporation has net income for tax purposes of $100,000. During the year, it donates $90,000 to a registered charity. Although the corporation donated $90,000, it cannot automatically claim the full amount because of the 75% limit. The maximum charitable donation deduction for the current year is $75,000. So what happens to the remaining $15,000? Fortunately, it is not lost. Instead, the unused donation becomes a carry-forward amount that can generally be claimed in one or more future tax years, subject to the rules of the Income Tax Act. This is one of the most valuable features of the charitable donation system. The tax rules recognize that some corporations may make very large donations in a year when their income is relatively low. Rather than denying the deduction entirely, the unused portion is preserved for future years. You can think of the process as 3 simple steps. First, determine the corporation's net income for tax purposes. Second, calculate the maximum charitable donation that may be claimed for the current year using the 75% limit. Finally, if the corporation's eligible donations exceed that limit, carry the unused balance forward to future tax years. The key idea is that the donation itself does not disappear. Only the timing of the deduction changes. This rule allows corporations to receive the full tax benefit over time, even if the entire donation cannot be claimed immediately. The golden rule to remember is simple. If eligible charitable donations exceed the annual deduction limit, the unused amount is generally carried forward to future tax years. It is not lost. In the next lesson, we'll work through a complete example to see exactly how this carry forward is claimed in a future year and how it affects the corporation's taxable income. Let's work through a complete example to see how the charitable donation carry forward works in practice. Suppose that in year 1, a corporation has net income for tax purposes of $100,000. During that same year, the corporation makes an eligible charitable donation of $90,000 to a registered charity. At first, you might expect the corporation to claim the entire $90,000 donation immediately. However, the Income Tax Act generally limits the charitable donation deduction to 75% of net income for tax purposes. Since 75% of $100,000 is $75,000, that is the maximum amount the corporation can claim in year 1. So what happens to the remaining $15,000? It isn't lost. Instead, it becomes a carry-forward donation that can generally be claimed in a future tax year. Now let's move to year 2. Assume the corporation has net income for tax purposes of $80,000. Since the corporation still has an unused charitable donation carry forward of $15,000 from the previous year, it may claim that remaining amount, provided it is within the allowable limits for year 2. After claiming the remaining $15,000, the carry-forward balance becomes 0 because the entire original donation has now been used. Notice what happened over the 2 years. The corporation donated $90,000 in year 1. It claimed $75,000 in the first year. Then it claimed the remaining $15,000 in the following year. Over time, the corporation received the full tax benefit for the entire donation. It simply could not claim it all in the same taxation year because of the annual deduction limit. This example also illustrates the normal workflow for charitable donations. First, the corporation makes an eligible donation and receives an official donation receipt. Next, Schedule 2 is completed to determine the amount that can be claimed in the current year based on the 75% limit. If any eligible donation remains unused, that balance is carried forward. Finally, the carry forward is claimed in one or more future tax years when the corporation has sufficient income and chooses to use it. One of the most common misunderstandings is believing that unused donations disappear at the end of the year. They do not. The key idea to remember is simple. If a corporation cannot claim its full charitable donation because of the annual deduction limit, the unused eligible amount is generally carried forward to future tax years instead of being lost. Understanding this concept is essential because it allows corporations to plan their charitable giving while still receiving the full tax benefit over time. Before claiming charitable donations on a T2 return, a tax preparer should always complete a few important review steps. Following a consistent process helps ensure that the corporation claims the correct amount and properly tracks any donation carry forwards. The first step is to review the corporation's charitable donation information. Gather the official donation receipts and verify that each donation was made to an eligible registered charity. These receipts are the foundation of the corporation's charitable donation claim. Next, determine the corporation's net income for tax purposes for the current year. This number is important because it is used to calculate the corporation's annual charitable donation deduction limit. Once the net income has been determined, calculate the 75% limit. This tells you the maximum amount of eligible charitable donations that can generally be claimed during the current taxation year. Now compare the corporation's total eligible donations with that annual limit. If the total donations are less than or equal to the limit, the corporation can generally claim the full amount. However, if the donations exceed the allowable limit, only the permitted portion is claimed this year, while the remaining eligible amount becomes a carry forward for future years. At this stage, it's also important to review prior year records. Many corporations may already have unused charitable donations carried forward from previous tax years. Before preparing Schedule 2, verify whether any carry forward balance exists and determine how much of that balance should be claimed in the current year. As you complete your review, ask yourself a few simple questions. What is the corporation's net income for tax purposes? What are the total eligible charitable donations? What is the maximum deduction allowed under the 75% rule? Are there any unused donations carried forward from previous years? How much should be claimed this year? And finally, is the remaining carry forward balance recorded correctly for future years? You'll also want to keep the appropriate supporting documents together. These include the official donation receipts, prior year Schedule 2 information, any carry forward schedules, previous T2 returns, the general ledger, and your tax calculation worksheets. The most important rule to remember is this: a corporation cannot always claim its entire charitable donation in the current year. Always calculate the annual deduction limit first. Determine the allowable claim, and then carry any remaining eligible donation forward to future tax years according to the Income Tax Act. Following this review process will help ensure that charitable donations are claimed accurately, no eligible deduction is overlooked, and every carry forward amount is properly tracked for future T2 returns.